Do you honestly believe the digital price on your screen reflects reality? Or are you waiting for the physical market to default before you realize you've been lied to? Silver just gapped up, and this isn't a rally. It's the first structural rupture in a system that has run out of metal. While you were sleeping, the world burned through an 820 million ounce deficit. The fuse is lit. Are you positioned for the repricing, or are you holding paper when the vault doors lock? Let's get one thing straight. The recent surge in silver, pushing its price toward highs we haven't seen in years, is not a temporary spike driven by futures market gamblers. It's the market waking up to a simple mathematical fact. For 5 years running, the world has used far more silver than it has produced. We are talking about a cumulative supply deficit since 2021 that is now approaching a staggering 820 million ounces. To put that in perspective, that's basically an entire year of global mine production that has simply vanished. It's gone. It's been consumed in solar panels, electric vehicles, and AI data centers, and it can't be recovered or returned to the market. While the paper markets played their games, the real world has been steadily eating away at the planet's available silver stockpiles. For years, this deficit was patched up by drawing down inventories in vaults and exchanges. But those stockpiles aren't infinite. The buffer is disappearing. What you're seeing with the price gapping up is the market finally reacting to alarm bells that have been ringing for half a decade. The problem is simple. Demand is now structurally and permanently outstripping supply, and supply is proving to be incredibly inelastic. It just can't keep up. The fuse that was lit 5 years ago has now reached the powder keg. This isn't just another silver squeeze hashtag on social media. This is a true, fundamental super squeeze where unstoppable industrial demand and surging investment demand are colliding with the reality of a market that can't produce more silver on command. The price action we see today is just the first tremor. Stop. If the supply is so stable as the banks claim, why are industrial giants quietly bidding up physical premiums while the paper price is suppressed? Who is actually holding the metal, and who is holding the receipt? Imagine your $10,000 investment skyrockets to $100,000 in just a few months as silver explodes past its old highs. This isn't a fantasy, it's the logical conclusion of a story that has been building for half a decade. This squeeze wasn't born overnight. It's the result of two powerful accelerating trends that have finally converged with explosive force. First, let's talk demand. Over the last 5 years, silver's role has completely transformed. It's become the critical, irreplaceable element of our green energy and tech revolution. Industrial demand is on track to roar past 700 million ounces, a new all-time record. This isn't the kind of demand that vanishes in a recession. It's structural. Every solar panel, every EV, every 5G tower, and every AI server farm needs silver. The global push toward decarbonization and advanced technology is, by definition, a global push for more silver. This creates an incredibly strong and rising floor for demand. While politicians debate climate targets, engineers are just buying up all the silver they can get. Now, let's look at the other side of the equation, supply. As this insatiable industrial demand was ramping up, something deeply concerning was happening with production. Despite prices doubling over the last decade, global silver mine production has been stubbornly flat. In fact, projected output for 2025 at around 824 million ounces is actually down over 7% from its peak in 2016. Think about that. In a normal market, higher prices should lead to more production, but not for silver. Why? Because over 75% of silver isn't mined for its own sake. It's a byproduct of mining for other metals like copper, lead, and zinc. Miners don't just open a new silver mine because the price is up. Their decisions are tied to the economics of those other metals. On top of that, the world has already picked the low-hanging fruit. The remaining silver is locked in deposits with lower ore grades, making it harder and more expensive to extract. Add in the increasing regulatory hurdles and political instability in key producing nations like Mexico and Peru, and you have the recipe for a permanently constrained supply. So, for 5 years, we've had relentless, record-breaking industrial demand on one side and a crippled, inflexible supply chain on the other. That massive deficit is the direct result of this collision. It's the mathematical proof that the market has been sleepwalking into a crisis, and the recent price gap is its wake-up call. The story is compelling, but the hard data makes this situation unavoidable. Let us break down the mechanics of this squeeze and look at the evidence that proves it's happening right now. The whole thesis rests on the dual engines of silver demand hitting a brick wall of inelastic supply. First, the demand engine. You have two forces working together. On one hand, you have the industrial demand behemoth. As we've covered, it's set to surpass a record 700 million ounces this year. The green energy transition isn't optional, and it's not slowing down. Governments are mandating it. Every single year, the amount of silver needed for solar panels sets a new record. The same goes for electric vehicles, which use significantly more silver than gas-powered cars. This creates a powerful, non-negotiable baseline of demand. These industries will pay whatever price is necessary, because without silver, their multi-billion-dollar production lines grind to a halt. This industrial consumption acts as a vacuum, permanently removing hundreds of millions of ounces from the market every year. On the other hand, you have the accelerator, investment demand. This is what takes a tight market and makes it explosive. As smart investors and the general public wake up to rampant currency debasement and stubborn inflation, they're turning to the oldest form of real money. We're seeing this in multiple ways. ETF inflows have been a major driver of the recent rally, but more importantly, there's a massive ongoing movement into physical silver, with reports of significant bullion flows into the United States as investors seek to protect their wealth. This isn't just a Western phenomenon. We're seeing shortages and premiums spike in markets like China, signaling a global scramble for physical metal. This investment demand is a vote of no confidence in the paper promises of governments and central banks. When the Fed expands its balance sheet by another $500 billion, or the national debt clock spins past another trillion, investors don't run to dollars. They run to hard assets. And silver, being the most undervalued hard asset, is a primary target. So, where does this demand meet reality? It meets at the doors of the exchanges and vaults, like the COMEX and the LBMA. For years, these vaults were the market's safety valve, releasing physical metal to satisfy the deficit. But that valve is now closing. While the exact numbers can be opaque, the trend is crystal clear. These available stockpiles are being drained. The registered category, which is silver available for delivery, has been under immense pressure. This creates the classic us versus them scenario of a true squeeze. On one side, you have the paper markets trading trillions of dollars in notional silver contracts. On the other, you have a growing army of industrial users and physical investors who are standing for delivery, demanding the real metal. As physical stockpiles dwindle, the paper promises become harder to keep. Eventually, a point is reached where there isn't enough physical silver to satisfy all the claims against it. That's when the price doesn't just rise. It gaps violently higher. The evidence shows we are rapidly approaching that inflection point. The squeeze is no longer a theory. It's happening right now. Ask yourself, when the AI and EV industries realize there isn't enough silver to fulfill their 700 million ounce hunger, do you think they'll care about your paper ETF? In a world of scarcity, if you can't touch it, you don't own it. So we have a structural deficit, record industrial demand, and soaring investment demand all converging on a shrinking pool of available physical silver. The inevitable outcome is a price explosion. This isn't wishful thinking. It's the simple law of supply and demand playing out on a grand scale. We're now in the recognition phase, where the broader market is being forced to reconcile the fantasy of paper pricing with the reality of physical scarcity. One of the most powerful signs that silver is poised for a major repricing is the gold-to-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Over the last few decades, that ratio has averaged around 69-1. Recently, it's been hovering at extremely high levels, sometimes as high as 80 or even 100-1. This means that, relative to gold, silver is profoundly undervalued. When this ratio begins to revert to its historical average, and it always does, silver doesn't just outperform gold, it multiplies gold's move. A return to the average from these levels would mean a massive upward revaluation for silver, regardless of what gold itself does. This isn't just our conclusion. Major financial institutions are being forced to admit this reality. Bank of America, for example, has put out a price target of $65 per ounce for silver, and they are not alone. Other analysts, looking at the severe supply-demand imbalance, are projecting targets of $70, $95, and even over $100 per ounce within the next 24 months. We've recently seen prices touch near $67, validating these bullish forecasts and showing the market has the momentum to push through. A sustained price above the $32 to $58 range confirms a new bull market with the potential for a parabolic advance. We've seen this movie before. In the late 1970s, a similar mix of inflation fears and a perceived shortage sent silver from $6 to nearly $50 in just over a year. While that event was tied to an attempt to corner the market, the underlying drivers were the same: a loss of faith in paper money and a scramble for a finite physical asset. The difference today is that the squeeze isn't being driven by a few wealthy individuals, but by an irreversible global industrial transformation and a worldwide movement of investors seeking a safe haven. The industrial demand floor is infinitely stronger and more permanent today than it was in 1980. The price you see on your screen today is a broken price. It's a relic of an old system that failed to account for the massive deficit and the dual demand engines. The recent gap up is the market's first attempt to correct that mispricing. But it is only the first step. As the physical squeeze tightens and the mainstream investing world finally grasps the magnitude of this situation, we are going to see a panicked rush into a tiny market. The move will be swift, it will be violent, and it will leave those who waited on the sidelines in disbelief. The solution isn't diversification, it's decoupling. You need assets with zero counterparty risk. This isn't just an abstract economic event. It's a tangible opportunity to protect your wealth and potentially generate life-changing returns. The solution to the problem of currency debasement, inflation, and financial risk has been around for 5,000 years. First and foremost, silver should be viewed as essential portfolio insurance. In a world of spiraling debt and unprecedented money printing, holding assets that are no one else's liability is critical. Physical silver, in the form of bullion coins and bars, is the ultimate safe haven. Owning the physical metal removes counterparty risk. It's an asset you can hold in your hand outside the digital and banking systems. For this role, a portfolio allocation of 5% to 15% is now considered prudent by many forward-thinking financial advisors. Second, for those seeking not just protection but also leveraged growth, there are several ways to get exposure. Silver ETFs offer a liquid way to play the price move, but the real explosive potential lies in the silver mining stocks. Mining companies provide natural leverage to the price of silver. Historically, their stocks can move 2-1 or even 3-1 relative to the metal. This means for every 10% jump in silver, a well-run miner's stock could jump by 20% or 30%. With silver prices rising, These companies are set to become free cash flow gushers. A balanced approach, like a 50-50 split between physical metal for safety and mining stocks for leverage, can offer the best of both worlds. The crucial takeaway is that the forces driving silver higher are not temporary. The green energy transition is a multi-decade trend. The loss of faith in fiat currencies is a long-term shift. This means that, unlike other commodities, silver's bull market isn't dependent on short-term economic growth. It's underpinned by long-term, non-negotiable drivers. The current environment, with high real yields and a strong dollar, would typically be tough for precious metals. Yet, silver is rallying anyway. That is the ultimate proof of the power of its fundamental story. It's a market breaking free of its old patterns because its physical reality has become too overwhelming to ignore. This isn't just a trade. It's a fundamental reallocation of capital. Physical reality does not negotiate with printing presses. The 820 million ounce hole is a mathematical debt that the paper market cannot pay back. The gap you see today is the first audible crack in a dam that is about to burst. By the time the mainstream media tells you to buy, the physical inventory will be gone. You have the data. You have the warning. Are you ready for the fallout, or are you the liquidity for those who are? The clock is ticking,